Good day to all our FAC3704 students. My name is Mrs. Jordan, and today we're going to be looking at investments in associates and joint ventures. You can get your tutorial letter 103 so long. We're going to be looking at question 3. We're not going to do the whole question. What we're going to do is you'll see in this question there's one associate and one joint venture. So we'll be looking at those two. Okay, so you can go and get your 103 in the meantime. Okay, so let's start. If you had to get this as a question, the first thing you would do was read the required. So let's read the required together. What are we required to do? Well, part A says, prepare the pro forma journal entries to account for the intergroup sale between Fire and Earth Limited. So now we know what we're required to do. However, at this stage, we don't know what is Earth Limited and what is Fire Limited. So our next step would be to go into the additional information and find out what they are. Well, we can see that Earth Limited is the investor company or the parent company. What is Fire Limited? Well, let's go and have a look. Additional information point number 3 tells us that Earth Limited acquired 15,000 of the ordinary shares in Fire Limited. And the last sentence of that paragraph reads, the arrangement was classified as a joint venture. Okay, so now we know that Fire Limited is a joint venture. So let's switch our pen on. Okay, with associates and joint ventures, the reason I'm doing them together is because they are both accounted for the same way. And that method is what we call the equity method. Okay, so the equity method is what we use to account for both associates and joint ventures. For this reason, I would suggest that you study these together, because if you can do one, you can do the other. The only difference is in the name, what we call them. The one is called an investment in associate, and the other one is called an investment in a joint venture. If we have to think quickly how they are accounted for, in your consolidated statement of financial position, I like to call each line item a box. We will have our property, plant and equipment box, any other assets that you can think of. We will also have our investment in joint venture box, investment in associate box, as well as all our current assets in their boxes. And the reason I like to think of it as a box is that everything to do with the investment in the joint venture and the investment in the associate must come into the correct box. If you put an amount in the PPE box, but it should be in the investment in joint venture box, we call it wrong disclosure. It's disclosed incorrectly. And in this module, if you disclose something under the wrong line item, in other words, put it in the wrong box, you will get no marks for that amount. Okay, so keep in mind that in your consolidated statement of financial position, the investment in JV has a separate box, as well as the investment in associate. If we go to our consolidated statement of profit and loss, once again we've got revenue, cost of sales, as well as all our other line items. Then we've got a special box for the associate and joint venture called share of profit from associate, and share of profit from JV. Okay, so if we think of our PPE, what goes into that line item? What do I put in this PPE box? Well, in this question, I've got a parent and a subsidiary, an associate and a joint venture. In my PPE line item, we are going to put 100% of my parent, which is earth, plus 100% of my subsidiary, which is water. In my investment and joint venture box, we're going to have a look at the detailed calculation just now. We are going to use the equity method to account for the investment in joint venture. And based on the name, you can see, what are we doing? We'll be putting the movements in the joint venture's equity into that line item. What about my investment in associate? Well, that's accounted for in exactly the same way. So again, we're going to apply the equity method in order to calculate the amount for the investment in associate. Do you see that none of the associates' PPE or their JV's PPE goes into the PPE line item? Only the parent and the subsidiary's PPE goes into the PPE line item. Okay, this is essential to remember. I don't want any of my associates or joint ventures PPE in the PPE line item. Where does my associates' assets and liabilities go? Well, I'm including the equity of the associate in the JV into the investments, and equity is in essence assets minus liabilities. So in effect, where are my assets and liabilities of my associate and joint venture? They've been included in my investment in associate and joint ventures line items. If we go to the statement of profit and loss, in my revenue line item, 100% of my parent plus 100% of my subsidiary. My joint venture and associates revenue does not go into the revenue line item. It does not go in the cost of sales line item. So where does all my associates' profit go? Well, my associate has a separate line item. And that line item is called share of profit from associate. And what goes into that line item? Well, it's basically my share, my percentage of the profit of the associate, which is the associate's revenue minus the associate's cost of sales plus the associate's other income minus other expenses minus income tax times my percentage. And that's the amount that goes into the share of profit from associate. So do you see, because we are including the associate's profit in the share of profit from associate line item, we will not go and put it in revenue and cost of sales as well. Only the parent and the subsidiaries' revenue goes into revenue. Only the parent and the subsidiaries' cost of sales goes into cost of sales. As well as share of profit from joint venture. In this line item goes my joint venture's profit, which is the plus their other income, tax. Very important, time my percentage interest. So do you see again, my profit of my joint venture goes into my share of profit from joint venture box or line item. And therefore it is not included in revenue and included in cost of sales. Okay, this is very, very important because like I mentioned a few minutes before, if you put an amount in the wrong box, there are no marks for that amount. So if you had to put the joint venture or the associate's revenue in revenue, you wouldn't receive any marks for it, because then you are not accounting for it like an associate or joint venture. And if you account for something the wrong way in this module, there are no marks for that amount. Okay, so this slide is very important to remember. So with that in mind, if we look at part A, we are required to do consolidation journals. Consolidation journals are all about line items. You are debiting a certain line item. You are crediting another line item. With an associate, with all entities, but specifically an associate, it is very important to remember that if we go back to the slide, there are only 2 line items that you can adjust in your statement of financial position. There are only 2 line items you can adjust in your statement of profit and loss. So with an associate, you have limited line items that you can debit and credit. Okay, and you'll see that now when we do the journal entries. Okay, so keep in mind, I've got 2 line items relating to my associate in my statement of financial position, and 2 line items relating to my joint venture. Okay, or I should actually say I've got 1 line item related to my joint venture, 1 to my associate in my statement of profit and loss, 1 for my associate, 1 for my joint venture. Okay, so let's do the journal entries. If we look at additional information, point number 3, they tell us on 1 September 2017, so our current year runs from 1 January 2017 to 31 December 2017. On 1 September 2017, Fire, my joint venture, sold furniture to Earth Limited, my investor. The furniture had a carrying amount of 135,000, and he sold it, so the proceeds that he made was 180,000. So, very important, I like to draw the transaction, because then I can just look at my diagram and see immediately in which direction the sale made. So who made the profit and who has the asset at year end. Just to change this color. Who made the profit? Well, my joint venture made the sale, so he must have made the profit. Who has the asset at year end? That would be Earth. So at year end, Earth Limited has the furniture. My joint venture made the profit. Because this is an intragroup sale, I want to eliminate this profit. So I know I need to debit or eliminate the line item in which the profit is currently sitting. If this was a subsidiary, you would know that I could debit other income or reduce other income. If I go back, however, in my other income line item, would my joint venture's profit be in that line item? No. Where is my joint venture's profit sitting? It's in the share of profit from joint venture line item. Because remember, in this line item went all the associates' revenue, joint venture's revenue, cost of sales, other income, other expenses, and income tax times my percentage. So the other income of the joint venture is in this line item. So based on that, we cannot take it out of other income because it's not in other income. It's in share of profit from joint venture. So we're going to debit share of profit from joint venture. what do we credit? Can we credit PPE? Well, we want to credit the PPE that's currently in the books of Earth. If we go back, where is Earth's PPE? Well, it's in the PPE line item. So therefore, yes, I can simply credit the PPE because Earth's PPE is in the PPE line item. And if we go to the calculation, it would be the proceeds minus the carrying amount times my percentage will give us 13,500. Okay, the next journal entry. That journal entry we did would have had a tax effect. However, can I debit or credit income tax line item for my associate or joint venture? No, because if I go back to my slide, where is my joint venture's income tax sitting? It's not in the income tax line item, it's in the share of profit from JV line item. So when I eliminate the profit that the joint venture made, because we're going to eliminate profit that the joint venture made, we're also going to reduce the tax of the joint venture. I cannot credit income tax because, like I saw, my joint venture's income tax is not in the income tax line item. Therefore, I need to credit share of profit from joint venture. Okay, because this is the line item in which the joint venture's income tax is. And my other leg would be deferred tax. Okay, and the amount there is simply the 13,500 times tax rate of 28%. 3780, 3780. Okay, so that's journal 2. Journal 3, this is a depreciable asset, and therefore the profit realizes over the remaining useful life. Who made the profit? Well, my JV made the profit. Therefore, whose profit realizes over the remaining useful life? My JV's profit realizes. Can I, if I think of a subsidiary, I would credit depreciation. Can I credit depreciation or other expenses for my joint venture? No, because I don't have this line item in my statement of profit and loss. Which line item do I have in my statement of profit and loss for a JV? My share of profit. So I'm limited. I have to credit my share of profit from joint venture line item. And debit accumulated depreciation or PPE. And that amount is 2250. Okay, because I'm realizing a portion of my joint venture's profit, it means my joint venture's income tax expense is going to increase. Can I debit income tax expense then? No, because my joint venture's income tax is not in income tax expense, it is in share of profit. So once again, I have to debit share of profit from joint venture and credit deferred tax. And that would simply be the 2250 times 28%. So do you see, every single time I wanted to debit or credit a statement of profit and loss line item for my JV, I had to stop and say, no, I don't have that specific line item for my JV. I only have one line item that relates to my JV on the face of my statement of profit and loss, and that line item is called share of profit from JV. So each time I had to rather debit and credit my share of profit from JV line item, because that's the only line item I have to work with. Okay, let's have a look at part B. Okay, part B says prepare the asset section. However, I'm only going to pick out the investment in joint venture and the investment in associate. So if we have a look at the statement of financial position, we know that one of our assets is going to be the investment in associate, and the other asset is going to be the investment in joint venture. Let's have a look at the investment in joint venture first. When calculating an investment in joint venture, or associate, you always start with the cost price. What did I buy this investment in joint venture for? And if you look at the additional information, you'll see that we bought this investment for 90,000 Rand. We add to the cost price my percentage of the movement in equity. For example, retained earnings. When I bought this investment at the beginning of the year, the retained earnings was 150,000. It increased with profit for the year, and it decreased with the dividend paid. So the movement in equity or retained earnings in this instance relates to the profit. So the profit for the year of the joint venture Fire Limited is 70,500. I own, just want to check the percentage, 30% of this joint venture. So the profit for the year that the joint venture made was 70,500. I own 30% of this joint venture, and therefore I am entitled to 150,000 Rand of this profit. Then the joint venture paid a dividend during the year, and he paid a dividend of 10,000. If increases in equity increase our investment, decreases in equity, like paying a dividend, decrease our investment. So minus 10,000 times 30% is 3,000. Okay, so once again, we start with the cost price. We say we paid 90,000. We increase it with any movements in equity since acquisition. Okay, because I acquired this JV on the first day of the current year, the only movements have been in the current year, which is my profit. I'm going to say, okay, the JV made a profit of 70,500 times 30% times my percentage is 21,150. That increases my investment in JV. If I pay a dividend, what happens to the equity of my JV? It decreases. Any decrease in equity of the JV reduces my investment in that JV. So minus my percentage of any dividend paid. Then what you also need to remember is that what I'll add to this investment is any gain on bargain purchase. And I'm going to show you why it's only gain on bargain purchase and not goodwill. If we had to calculate the goodwill or gain on bargain purchase on this investment in JV, you will see that there's goodwill of 15,000 Rand. That goodwill of 15,000 Rand is the difference between the net assets acquired and the cost price that I paid. You can also see that in the analysis of fire. When I start accounting for a JV under the equity method, I always start with the cost price, this 90,000 Rand. This 90,000 Rand is the combination of the net assets that I acquired of 75 and the goodwill of 15. Do you see that when I start with the cost price of 90 and there was goodwill on the acquisition, that cost price will already include any goodwill if applicable, because the cost price will always be equal to the net asset value that I acquired plus any goodwill if applicable. Therefore, if there is goodwill, like in this case 15, I do not go and add the goodwill separately, because I say that I start with the cost. This 90 is the combination of the net assets that I acquired of 75 plus goodwill of 15. So it has already been included. I don't need to go and add the 15 again. We'll compare that now to the gain on bargain purchase. So gain on bargain purchase, nothing, because I determined there was goodwill. If I add that up, I get 108,500, and I go and disclose it on the face of my statement of financial position. Investment in JV, 108,500. Okay, what about the investment in associate? You'll see it's a very similar calculation. Investment in associate, Air Limited. Once again, I always start with the cost price. What is the cost price of my investment? They give it to us. They tell us that we bought this investment for 45,000. I add to that any gain on bargain purchase. If you calculate the gain on bargain purchase, you'll see that in this instance, there is a gain on bargain purchase of 3,000. I'm not going to go into the calculation because you'll see it's a very simple gain on bargain purchase calculation. And it is equal to 3,000. So I'm going to add the gain on bargain purchase of 3. The reasoning behind this is because the net assets that I acquired is 48,000. In this instance, I paid 45. So there's gain on bargain purchase of 3. When I start, we always start with the cost price. The 45,000 is what I start with. However, the net assets, the value of my net assets that I acquired is not 45. The value of my net assets that I acquired is actually 48. So if I only include 45, my investment in associate is going to be lower than what I actually bought. And therefore, whenever there's a gain on bargain purchase, I go and add the gain on bargain purchase. So that after I've added the gain on bargain purchase, my investment in associate is sitting at 48,000 Rand, which is the net asset value that I acquired. Okay, so important. Start with the cost price, then add the gain on bargain purchase. What's my next step? Well, to add any movements in retained earnings or equity. At the acquisition date, my retained earnings was 40,000 Rand. At the beginning of the current year, it's increased to 120. So what has it increased by? My retained earnings has increased by 80,000. Am I entitled to the full 80? No. I only own 40%, therefore I'm entitled to 40%. 32,000. What else has happened to my equity? Well, in the current year, this associate has made a profit of 706,200. Am I entitled to the full 706,200? No, I am entitled to 40%. Okay, when the equity of my associate increases, I add it to my investment in associate. Therefore, when my associate paid a dividend, their equity would have decreased. And therefore, I'm going to deduct it from my investment in associate. So my associate paid a dividend of 30 times my percentage of 40%. 8,000 Rand. Do you see I'm following exactly the same recipe as for my joint venture? What about intragroup transactions? Well, I would deduct intragroup transactions where my investor sold to my associate. Okay, and I'm going to show you now why only that way around. If we look at the intragroup transaction with Air Limited, we say that our investor, Earth, sold inventory to Air. Okay, who made the profit? My investor made the profit. Who has the inventory or the asset at year end? My associate has the inventory or the asset at year end. The associate that the investor made on this inventory is sitting in the investor's revenue and cost of sales. Okay, so it's basically the gross profit. The inventory that the associate has, is it in the inventory line item? If we go all the way back, we see no. My inventory of my associate is not in the inventory line item. It's in the investment and associate line item. So I'm going to credit investment and associate and not inventory. And the amount that I'm going to debit and credit by is going to be the unrealized profit, but times 40%, which is going to be 12,000. Okay, so do you see when the investor made the profit and the associate has the asset or the inventory, I can debit and credit cost of sales to eliminate the gross profit. But when it comes to the inventory in the books of the associate, I'm very limited because I can't credit the inventory because I don't have the associate's inventory in the inventory line item. I only have one line item in the statement of financial position, and that line item is called investment and associate, and therefore I have to credit that line item. If I had to turn this transaction the other way around, and I say, okay, now my associate sells to my investor. Who makes the profit now? The associate makes the profit. Who has the asset? The investor. Now it's similar to my previous example with the furniture. If I want to eliminate this 12,000 Rand profit that the associate made, can I debit and credit the gross profit of the associate? No, because the gross profit of my associate is not in that line item. The gross profit of my associate is in the share of profit from associate line item. So therefore I can only debit my share of profit from associate line item with the 12. My investor has the asset, or in this instance the inventory. Can I therefore credit inventory? Yes, I can, because my investor's inventory will be sitting at 100% in the inventory line item. So I can simply credit inventory. Do you see the difference? So with an associate and a joint venture, it's very important to know who made the profit and who has the asset. Because can you see that the disclosure and how that profit is eliminated is totally different compared to this scenario compared to this scenario. So which of these two scenarios affect the investment? Only this scenario. This scenario here, do I do anything to the investment? No, there is no effect on my investment in associate line item in this scenario. This scenario here, there is no effect on my share of profit from associate line item. So going back, can you see here why I wrote only when my investor sold to my associate will there be any impact on my investment in associate line item? So I'm going to deduct the 12,000 Rand. If my associate had sold that inventory to my investor, then I would have said here, there is going to be no effect on my investment. Because where does the effect go? I'm going to adjust my share of profit, and it's going to have no effect on my investment. Okay, so I can't stress enough how important it is to know which way the sale happened. I also find it very nice if you can draw the diagram. So draw this for yourself in the exam. Then every time you forget who sold to who, you can simply look at your diagram and say, oh yes, my investor sold to my associate. Right there, profit and asset. Then if you forget, you can simply look and say, oh yes, it was my investor that made the profit, and oh yes, it is my associate that has the asset. Okay, hopefully this broadcast has shed some light on how to account for investments in associates and joint ventures. Just remember, study them together because they are accounted for in exactly the same way. Take this question, go and do it yourself. If you have any problems, you're more than welcome to contact us, and I hope you have enjoyed this broadcast. Thank you. Bye-bye.